Americans are drowning in stuff. The United States has more than 50,000 self-storage facilities, more than the total number of McDonald's, Starbucks, and Subway locations combined. 1 in every 10 American households currently rents a storage unit. The self-storage industry generates over $40 billion in annual revenue, and it has been one of the most consistently profitable sectors in American real estate for decades. And here's the kicker. Self-storage was one of the very few real estate categories that actually maintained occupancy and cash flow during the 2008 financial crisis and during the COVID-19 pandemic. Today we're breaking down the self-storage business model, why it works so well financially, how regular investors can get exposure to it, and what you need to know about both the opportunity and the risks. Why self-storage works. The self-storage business model has several structural advantages over other real estate categories. Low capital expenditure. A storage unit is 4 walls, a roof, and a roll-up door. There's no kitchen to renovate, no bathroom to upgrade, no appliances to replace. When a unit turns over, you sweep it out. Maintenance costs are a fraction of residential or commercial real estate. Short-term leases. Most storage unit leases are month to month. This means pricing can be adjusted rapidly in response to demand, both up and down. During inflationary periods, operators can raise rents quickly without waiting for long-term lease expirations. Demand resilience. People store stuff when they're moving up, buying a bigger home and needing temporary space. They store stuff when they're downsizing, kids leaving for college, divorces, deaths in the family. They store stuff during economic hardship, when they can't afford a larger apartment. The triggers for demand are diverse and persistent regardless of economic conditions. Low staffing requirements. A modern self-storage facility can be largely automated. Digital access codes, online rentals, remote management, with minimal on-site staff. The financial metrics. Understanding self-storage investment requires familiarity with a few key metrics. Occupancy rate. Most stabilized storage facilities target 85 to 92% physical occupancy. Economic occupancy. Revenue as a percentage of theoretical 100% full rent is the more relevant figure. Revenue per square foot. Street rates for self-storage vary dramatically by market. Urban markets like New York and Los Angeles can command $3 to $6+ per square foot monthly. Suburban and rural markets might range from 80 cents to $1.50. Market research on local supply and demand is critical. Cap rates. In 2024 to 2025, self-storage cap rates nationally have ranged from roughly 5% in primary markets to 7 to 8% in secondary and tertiary markets, reflecting investor demand for the asset class. Net operating income, after property taxes, insurance, management, and maintenance, typically 35 to 45% of gross revenue. The margins in self-storage are high relative to other real estate categories. How to invest in self-storage direct ownership. Buying or developing a self-storage facility is the highest return, highest involvement option. Acquisition costs for an existing facility range from $1 million to $10+ million depending on market and size. Ground-up development requires navigating zoning, construction, and lease-up risk. This path requires significant capital and operational expertise. Self-storage REITs, the most accessible path for most investors. Public storage, PSA. Extra space storage, EXR, now merged with Life Storage, CubeSmart, CUBE, and National Storage Affiliates, NSA, are the major publicly traded self-storage REITs. They offer liquidity, diversification, and professional management with no operational involvement. In 2024 to 2025, these REITs have faced headwinds from new supply in key markets. Something to monitor. Private equity funds and syndications. Many private real estate firms offer self-storage specific investment opportunities through qualified investor vehicles. Minimum investments typically range from $25,000 to $100,000 plus. Small facility. Acquisition. Some of the best opportunities exist in the middle market. 50,000 to 150,000 square foot facilities in secondary markets that are undermanaged and can be optimized through better pricing, marketing, and technology. This is where entrepreneurial investors with some real estate experience can generate outsized returns. The risks oversupply. The biggest near-term risk in self-storage. The high returns of the past decade attracted enormous new development capital, and many markets, particularly in the Sunbelt, are facing significant new supply. Occupancy and rents are under pressure in overbuilt markets. Market selection: a storage facility in a growing suburban market with strong demographics is a fundamentally different investment than one in a declining rural area. Local demand drivers matter enormously. Interest rate sensitivity: like all real estate, self-storage values are sensitive to interest rate changes. The cap rate expansion of 2022 to 2024 compressed valuations, and the path of interest rates will continue to influence values. Disruptive risk: on-demand storage services. Companies that pick up, store, and deliver items are growing in dense urban markets. While not an existential threat to traditional self-storage, it represents incremental competitive pressure in certain geographies. Self-storage is one of the most compelling niches in American real estate, and it's been hiding in plain sight for decades. The combination of low operational complexity, demand resilience, and strong cash flow characteristics makes it a legitimate component of a diversified real estate portfolio. The opportunity in 2025: public REIT valuations have been compressed by interest rate pressures, making them attractively priced relative to their long-term histories. For investors with more capital and appetite, the private market for small and mid-sized facilities continues to offer deal flow in markets where new development hasn't yet caught up with demand. This is an asset class that rewards patient, data-driven investors who understand their local market. As with all real estate, research, underwrite carefully, and don't overpay. If this opened your eyes to an investment most people walk past every single day, hit subscribe. We break down opportunities like this every week, and you don't want to miss what's coming next.